News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardian Show with Doug Ray, helping you retire the job and keep the paycheck. This morning, you have Brice and Garrett Ray in, and today we are talking about retirement planning for high net worth individuals. Good morning, Brice. How are you?
Good morning, Garrett. I am doing well. Hope you are on this cold weekend.
Yes, it is.
Yeah, this entire show, both segments here are going to be about high net worth individuals and things that they need to focus on when going into retirement. Happy weekend, everybody out there. Thank you for joining us. As you know, or might not know if you're just tuning in for the first time this year, we are expanding the opening of the show here to get to know your Wealth Guardian financial advisor a little bit. And we're going to ask every show, at the start of the show, each advisor a question. And so the question, and we can ask this to you out there as well. Garrett, here's the question this week.
Okay.
If you could have any exotic animal as a pet, what would it be?
Yeah, I don't know if this necessarily qualifies as an exotic animal. I think it probably does. But I've always thought that, and you see videos about them every now and then, but like the little sugar gliders that you can get.
My daughter had one of those.
Yeah. So it's like, I always thought they were kind of cool. You can throw your pet up in the air and it glides back down to you and stuff.
Highly overrated. Yeah. As a pet. But I hear you. They're safe. They sleep most of the time.
Yeah.
For me, most exotic animals either have fangs, claws, or venom, or a combination of all three. Okay. So I try to stay away from exotic animals unless I'm in a zoo. But I've always been intrigued by what is called the Savannah cat, which is a cross between an African serval and a Siamese cat. And they can get up about 25 pounds, and they're incredibly loyal, like dogs, apparently. Huh. And if my wife was a cat person, I'd be all in on getting one of those, but she's not. But at least we're not sugar glider people.
There you go.
So, all right. Well, there we go. So you ask yourself out there, what exotic pet would you want, and see if it compares to what Garrett and I would choose as exotic pets. But anyway, let's go ahead and get started on the show here, Garrett. Retirement planning for high net worth individuals. Today's episode, we're taking a close look at high net worth individuals and those who have accumulated significant wealth and face unique challenges and opportunities when planning for retirement. And unlike the average person, their financial considerations go a little bit beyond the basics. And we're going to explore the distinct strategies and factors that come into play when securing a comfortable and prosperous retirement.
Sure.
And the first one that we'll dip into, Garrett, is as far as unique situations that high net worth individuals need to consider are portfolio complexities. What would you say about portfolio complexities?
Well, anytime you're talking about a high net worth individual or couple, their portfolios and their financial situation are just going to be naturally more complex. They're typically going to have more accounts associated with them. Likely they're going to have multiple streams of income that you have to consider. They typically are going to have more liabilities and that sort of thing on their plate. Some things that we've kind of experienced is, if you have like someone who was an executive at a company, they might have like a deferred compensation plan that is still kicking off a stream of income inside of retirement. So when we have conversations about with our clients about, hey, what are your various streams of income? How are we going to basically account for this from a tax standpoint? That is definitely something that we need to ask. Say, okay, do we have any deferred compensation plans out there? Likely folks who are in a higher net worth status are going to have typically another, at least a second property of some sort, whether that's a family property or a vacation property or something like that. They may also be considering different investment types that open up at once you become a qualified investor, a private equity holding, some international investments. There's also the life insurance retirement plan, a LIRP, that is beneficial for some in order to accumulate a cash value such that you can basically take that cash value out, a loan against yourself or your own policy, take it out tax-free. That helps with some of the tax stuff that high net worth individuals have to consider, because they have all these other taxable accounts that they have to basically offset that with. So as a bottom line, just the complexity tends to go up when you get higher net worth individuals and couples and households. And so when you start to kind of look at the estate planning and if this couple has legacy goals and that sort of thing, that's something that we definitely need to be considering.
Yeah, for somebody who is maxing out their 401k for years, and that more or less is the extent of their retirement savings, it's not very complex. You've got some mutual funds to choose from, and it's all one kind of pre-tax account. So it doesn't get very complex with that. But let's say that you're maxing out your 401k, you're getting the company match, you're maxing out your IRA, and then you've got extra monies that you still want to invest. Well, now you've got beyond just mutual funds, as you said, and we've even had clients come in here who have stock options, company stock options, and that can get complicated as well. And it really goes beyond, you leaned on this just a moment, and we're going to talk some more about it, but it goes just beyond what should a diversified portfolio look like in the form of growth potential, but keeping Uncle Sam's hands off of it as much as possible. And that's really where you need either a CPA or perhaps more a retirement income certified professional who is familiar with all the different tax codes and the different types of investments that can keep Uncle Sam's hands off of that as much as possible. Yeah. If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. In the studio this morning is Garrett Ray and Brice Payne, and we are talking about retirement planning for high net worth individuals and the unique situations that high net worth individuals should consider. So we just talked about the complexities of portfolio allocation. Garrett, let's move on to taxes. Taxes just covers, that word there and tax mitigation seems to worm its way into every subject that a financial planner talks about, whether it's portfolio allocation or Social Security filing. It all comes down to taxes. Yeah, you want to grow your portfolio, sure, but the second and just important article of consideration is how do we keep Uncle Sam's hands off as much of it as possible? And there's some strategies there that just somebody who's not a high net worth individual or an accredited investor, like you said, doesn't need to concern themselves with. But I'll start off with the word provisional tax. Yeah. Now, when I say that, most people out there think, well, I haven't heard of provisional tax. If you haven't heard of provisional tax, you probably haven't filed for your Social Security yet. But so you filed for taxes for your last 40 years or so, but you are familiar with adjusted gross income, maybe even modified adjusted gross income. Well, once you file for Social Security, another type of tax bracket pops up, and it's called provisional tax, and you have to be familiar with what that is, because that's going to determine a couple of things: what Medicare tier you fall into, and whether or not your Social Security is filed at 0%, 15%, 50%, 85%. So there's a number of different things there that we have to consider to keep, again, capital gains and just Uncle Sam's hands off of much as possible. What would you say about taxes there, Garrett? Yeah,
you just brought up capital gains. That's inside of a brokerage account or a non-qualified account. If these folks have been invested for, let's say, 20 plus years and they haven't done a lot of portfolio rebalancing, it's quite possible they could have bought a great company back in the the mid 80s, mid 90s, and they have a massive capital gain on there. It looks good on paper, but the moment that you start selling off some of your positions to supplement your income in retirement, now you're subject to capital gains. And so what we talk about is some tax loss harvesting, looking at portfolios from a holistic standpoint, not just necessarily, hey, ABC stock is up, on my portfolio 400 and whatever percent because I bought it back in the 1990s. How do we start offsetting some of those massive capital gains with capital losses to draw down the taxable amount that person's going to have to pay on the entire portfolio? So that we just kind of get into that level of tax planning just across the portfolio, in particular for specific accounts. One other thing that you had brought up is that with the complexity and tying it into taxes is folks who tend to have a higher net worth also tend to be incredibly generous folks. But what comes to mind is, a qualified charitable distribution out of an account going into a charity of their choice also gets a little bit of a tax advantage for them. So we can help clients with that as well. Yeah,
and let's just do the quick math here. I did this before starting the show. Let's say that you've accumulated $2 million in IRA monies. Okay. And at 73, you need to start taking RMD, required minimum distribution. Maybe you don't need to take out that much from your IRA to supplement your Social Security. Exactly. Doesn't matter. Or Uncle Sam's going to force you to. And at 73, you've got $2 million in an IRA. That RMD, just to start off with, is $81,000.
That's wild.
But that goes up more and more each year, and it peaks somewhere in the mid-80s or early to mid-80s for most people. That $81,000 could be as much as $200,000. If you don't want to take out $200,000 from your IRA
and count it towards your income,
tough, according to Uncle Sam. But as you said, there is something called a qualified charitable distribution.
Yeah.
Now, if any of these that we talked about so far in this first segment is striking a chord with you, and you think, hey, maybe I really should sit down with a holistic financial planner, somebody who's a retirement income certified professional and knows how to talk me through this. You've never had to deal with it before retirement. This is just you're in the accumulation phase here, and you're not being taxed on all these pre-tax investments that you've made for yourself over the last couple of decades. Well, here's how you do that. You pick up the phone and you call 336-391-3409. Let me give you that number again, 336-391-3409. There is no cost, no obligation to sit down with Doug, Garrett, or myself and see what services or wisdom we can help you out with and make sure that your retirement is properly aligned for, a decent amount of growth, but also, again, keeping Uncle Sam's hands off as much of that as reasonably possible. It's a 4-meeting process generally, but people who go through this process will tell us routinely that it is the most thorough planning process that they've ever gone through. And so we take pride in that, Garrett.
I would agree, absolutely.
All right, well, we're going to have to take a break here, but before we do, we always go to the trivia question, and this week it'll be me asking Garrett and you out there the question. So, Garrett, are you ready?
Oh, man, I hope.
All right. On January 16th, 1919, Congress passed the 18th Amendment. What is the 18th Amendment? On January 16th, 1919, the 18th Amendment was passed. What is the 18th Amendment? Stick around for the answer to that trivia question and see if we stumped Garrett on the other side of this short break. This is Brice Payne. With me is Garrett Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardian Show with Doug Ray, helping you retire the job and keep the paycheck. I'm Brice Payne along with Garrett Ray this week. And in the second segment, we're going to continue our conversation around high net worth individuals. And the second segment, we're going to be talking about 3 retirement planning myths that hurt high net worth individuals. Now, in that first segment, you heard me ask Garrett a trivia question. And before we get to his answer, I've got 2 questions for you. 1, are you looking forward to your retirement? Sure you are. 2, do you want to make sure you're making the best financial decisions for your retirement? Sure you do. So you answered yes to both those questions. Then Garrett and I have great news for you. We here at the Wealth Guardians offer a no cost, no obligation, and I'm going to repeat that part, a no cost, no obligation second opinion / review of your retirement plan. This will include a deep analysis of your assets, your investment portfolio, your insurance policies, your income needs, your risk tolerance, your risk exposure, most importantly, perhaps your tax mitigation strategies, and even your legacy goals and the fees you are currently paying. So here's our goal. We want to help you lower your fees and align your risk to improve your overall retirement picture so you can indeed retire the job and keep the paycheck. However, the ball is in your court. This is what you got to do. You got to pick up the phone and dial these numbers in these orders: 336-391-3409. That's 336-391-3409. Give us a call or visit us at thewealthguardians.com to set up your financial plan review with Doug, Garrett, and myself today. I want you to remember the markets aren't going to wait for you. And by the way, speaking of our website, thewealthguardians.com, I want to draw your attention, since it is tax season, to our website. If you go to thewealthguardians.com and go to the Media Center tab, and you scroll over that, you can click on free financial reports. We've got a number of them, but the one that I want to bring your attention to in January here, and perhaps even February, is our Tax Survival Toolkit, 5 critical strategies every retiree should know. There's an easy download button for the PDF right there below it. There is nothing you need to do other than read it and see what types of information are there that will help you tax-wise in your retirement. So again, thewealthguardians.com, go to the media tab and scroll over that and click on free financial reports. All right, let's go ahead and get to that trivia question. Garrett, are you ready?
I think so.
All right. You know, my trivia questions often are about American history or sometimes world history. Sometimes we date back, way back to ancient times, but this is just in the 20th century. On January 16th, 1919, the 18th Amendment was passed. What is the 18th Amendment?
Okay. I like to think I know our Constitution fairly well, but I will admit this particular amendment has escaped me. I know what the 17th is. I certainly know what the 21st is. Is the 18th Amendment when they chose to enact prohibition? Okay.
Wow, look at this guy.
I know 21 repealed prohibition.
Yeah, there you go. Yeah. So you knew it was below 21, right?
Yeah.
Very good. Here you go. Let me ask you this. What exactly was prohibition?
Basically, I mean, I don't know what it says in the Constitution verbatim, but essentially it was the banning of mass distribution of alcoholic beverages to the public.
The transportation or sale
correct
of alcohol. So a lot of people think, who are around now, think that was a period where alcohol was illegal in its entirety. No, it wasn't. That's where we got bathtub gin. It was completely legal to have it in your own household. You just couldn't transport it and you couldn't sell it to somebody.
Right.
But you could have those parties in your own place. All right. Well, let's go ahead and get to our second segment here. 3 retirement planning myths hurting high net worth individuals. And Gary, you want to start off with that first one?
Yeah. So this is an interesting kind of question or phrase we may hear from time to time, and it goes something like this. Brice goes, "I have so much net worth, I really don't need to worry about a sustainable withdrawal rate from my accounts." In other words, this person is saying, you know, I don't think I could ever spend it all down. And while that might be true, if you're at that particular level, it's still worthwhile talking through a financial planner and doing a detailed assessment of what different accounts and investments you do have. What's the liquidity status of some of these? If you're someone who has a ton of real estate, right? Real estate is largely illiquid unless you have tenants that are paying you some sort of like rental income stream from that. But the asset itself, selling that can take months, sometimes years to sell a piece of property, depending on what it is.
Right.
And by the way, if that property is also of a high worth, there's less and less buyers out there. You know, it's selling something like $150,000, $200,000 home, much more potential buyers than selling a multi-million-dollar property. So there's that type of planning that we have to consider. The other thing too is, you know, if we just willy-nilly draw down the accounts and there's not really a plan on what we're pulling from, when we're pulling from, we have really no idea what the tax liability year over year could be for you.
That's true. We're bringing up that tax word again, aren't we?
Exactly. And so you can hear a common theme. At some point, we want to try and become as efficient as possible about our taxation. At least most people would, I would think. But, you know, that's something that I certainly consider is that, yeah, you may not necessarily be able to spend it all down. But as we do begin to draw down off of it, how can you be most efficient from a tax perspective? And also, how much true liquidity is in the overall high net worth individual?
Yeah, we do have clients here of different financial statures, and yes, certainly some of them need to be less concerned about a sustainable withdrawal rate than others, but I don't think that anybody should not be concerned, period. And we're in the height of football playoff season right now, Garrett, and so if you consider the growth of your account like the offensive side of a football game and paying Uncle Sam the defensive side of the football game, both are just as important. It doesn't matter how many points you score if your defense is just soft.
Sure.
So you have to have a strong offense and you have to have a strong defense. So translating that into a retirement planning, you have to have a strong growth policy or strategy, but you have to have keep a strategy to keep as much of that out of Uncle Sam's hands. That's the defense as possible. And so there's ways of structuring your accounts that gets a little bit more complex for a high net worth individual than it does for somebody, again, who's saved most all of their assets through a 401k or an IRA.
Right.
And that's what a holistic financial planner is going to help you do. Now, if you're just tuning in and you're listening to the Wealth Guardians show, Garrett, Ray, and Brice Payne here are talking to you about 3 retirement planning myths hurting high net worth individuals. That first one we talked about is, I have so much net worth, I don't need to worry about a sustainable withdrawal rate. Okay, so we kind of proved that that's not true. The second one we want to go into here is, once your net worth hits a certain level, you don't have to worry about creating an income in retirement. And I would say, I'd bring up one word on that one, and that would be inflation.
Yep.
So if you think that inflation is going to be 2% for the entirety of your retirement, then go ahead. You don't need to worry about creating an income in retirement. Good on you.
Right.
But if you, let me ask you, raise your hand if you think taxes are going to go up, or not taxes, I'm sorry, if you think inflation is going to continue to be higher than that 2% average that we have had over the last, I guess it's like 3.27. But if you think inflation is going to be higher than that over the course of your retirement, raise your hand. Okay, I suspect most people out there raised your hand. Then how on earth, if you're a high net worth individual and you just raised your hand, do you believe that you don't have to worry about creating income in retirement?
Yeah, I mean, it's interesting that you bring that up. It's I think the amount of people that have actually considered inflation as creeping into their their overall nest egg, if you will, might be, as we talk to folks, 10 to 20%. Most folks don't even consider it. They'll talk about what percentage of their portfolio they have planned on drawing down and that sort of thing. Oh, I think I'm going to take out 4% of my portfolio per year, something like that. One of those rules of thumb that you think. But almost no one has looked at, how much am I spending inside of my household on a monthly basis, yearly basis, and then inflating that out over a 20, 30-year retirement and seeing, okay, does that nest egg actually still keep up or not?
Right.
Absolutely something that you need to consider, should consider, to understand about, okay, maybe it is time that we start to get serious about creating an income plan for you in retirement, regardless of your starting point of net worth.
Yeah, I agree completely. And if creating that retirement plan that does take into account inflation, taxes, all of that, then I would encourage you to reach out to the Wealth Guardians, and our phone number is 336-391-3409. You can also reach out to us at thewealthguardians.com. We offer, as we said in the first segment, a no cost, no obligation second opinion / review of your portfolio that helps you see what your nest egg is going to be year after year, after we calculate taxes, after we calculate income and your withdrawal rate and your spending. Maybe there's going to be some of those one-off expenditures in retirement that is not part of your monthly expenditures. Maybe you're going to buy a second home at some point, or you're going to buy an RV, another property, what have you. You have to be able to calculate those, and where are you pulling that money from? Is that going to create a taxable event? What kind of tax bracket is that going to kick you up to? Is there ways to avoid being kicked up into that tax bracket? If you have a drawdown strategy, maybe you don't just have IRA monies that you can fall back on, but you've got some Roth monies, or what are called life insurance retirement plan monies as well. And Garrett, you mentioned in the first segment about implementing a strategy to tax loss harvest some of your long-term or short-term capital gains. There's ways to do all of that perhaps you're somebody who's just done all of their saving in an IRA or 401k might not be so important, but for somebody who's saved in IRAs, 401ks, Roths, LIRPs, non-qualified accounts, it does get really complicated, and you really want to make sure that you're going through all the different aspects of planning so that, yes, your portfolio is growing to a reasonable amount, but you are keeping as much of that money for yourself and for your legacy goals instead of forking it over to Uncle Sam. Garrett, I think that's going to about run the tables for this week, don't you think?
We just have that deadline. It keeps creeping up on us.
There you go. Well, thank you for joining me, Garrett, and thank you out there for joining us. And unfortunately, that's all the time that we have. We hope the rest of your weekend is everything you want it to be. This is Brice Payne along with Garrett Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And I want you to remember, sound financial plans do not create themselves. This is News Talk 94.5 WPTI. This is 96.7 FM WTOB.